that the combined entity is better positioned to maximize long-term value together versus each company individually. There are a few key highlights of this transaction that I'd like to briefly touch upon. First, production from the two companies will be over 340,000 BOE per day in 2021, comprising approximately 140,000 barrels per day of liquids, of which over 50% is high margin condensate, and approximately 1.2 BCF per day of low-cost natural gas. ARC will now be the largest pure-play Montney company, the largest condensate producer, the third largest natural gas producer, and the sixth largest upstream energy company in Canada. The combination will allow us to considerably enhance our diversification amongst our product, geographic, and marketing and sales mixes. We think this will give us greater optionality in allocating capital through all the price cycles and in diversifying risk. By combining these two efficient, focused organizations, we'll be able to generate significant free cash flow, which we will be immediately accretive for all shareholders. ARC's existing quarterly dividend of 6 cents per share will remain a key component of the combined company's returns-focused value proposition. The combination is expected to yield synergies that will deliver approximately $110 million in annual cost savings by 2022. Enhancing the company's free cash flow profile will increase the ability to fund the development of ARC's Attachie asset, further development of Seven Generations Nest asset, and increased return of capital to shareholders through share buybacks or dividend increases. Also of great importance, combining with Seven Generations preserves ARC's strong financial position, which has been a key pillar of our company since we started 25 years ago. Our company will have a low-cost capital structure with ample liquidity. Initial leverage for the combined company will be slightly above ARC's targeted range, but we have a strong deleveraging plan in place that will reduce the combined net debt to an expected 1.3 times funds from operation by year-end 2021, based on forecasted commodity prices. We will continue to target to be between 1 and 1.5 times debt to cash flow over the long term. We have always admired Seven Generations for their enduring commitment to ESG leadership and strong stakeholder relations. We believe that the combination will elevate our collective position as an ESG leader in the energy sector, both in Canada and globally. ARC's ESG strategies and practices are integrated with all that we do. This will be a large part of our corporate vision going forward as the world transitions to a lower carbon economy and the combined company further differentiates itself from its peers with its leading environmental, social, and governance performance. The combined company will bring together the strengths and talents of both organizations to drive superior performance. From a governance and leadership perspective, Hal Kvisle will remain as the chair of the board, and we're excited that Marty Proctor will be joining as vice chair. In addition to myself, 4 more directors from ARC will be selected to serve on the board, as will an additional 4 directors from Seven Generations. I will lead ARC as president and CEO, with Chris Bibby as CFO, and we're excited that David Holt from Seven Generations will be joining the team as COO. Other senior leadership positions will be announced before the expected close of the transaction. By becoming the premier Montney company, we expect attractive free funds flow generation at all price levels and are well hedged to reduce the volatility in those cash flows. Our sustainable business model, which is founded on owning high-quality assets, including over 1.1 million net acres of Montney land with decades of top-tier inventory, demonstrating capital discipline, delivering operational excellence through managing a low-cost structure with owned and operated infrastructure, and leading ESG performance will all continue to be key tenets for the organization. Maintaining financial strength and focusing on corporate profitability and maximizing shareholder value will also be of paramount importance. Ultimately, ARC believes that combining with Seven Generations will not only enhance but accelerate our investment thesis. The significant alignment that exists between the two companies makes this a logical transaction that will create significant value for shareholders of both companies for many years to come. I want to personally thank Marty for leading such a great company in 7 generations and for being open-minded to combining two great companies to further enhance shareholder value. I'll leave it to Chris to cover off some of the particulars of the transaction, but want to pass it over to Marty to say a few words first.
Thank you for your perspective and the kind words, Terry. As an organization and as shareholders, we are excited about this combination and the opportunity it brings. ARC has always been a company we have held in the highest regard. We respect ARC's approach to responsible development, its commitment to operational excellence, disciplined capital allocation, consistent shareholder returns, and governance practices. When discussions were first initiated, we saw that the combined entity would have the scale and high-quality asset base that is critical to remaining competitive in both the transitioning energy industry and the evolving capital market space. We see a combination with ARC as an opportunity to rapidly accelerate our strategic initiatives, reducing our corporate decline rate, lowering our debt levels, and immediately opening the door to returning capital to our shareholders through ARC's dividend. In return, we are contributing our condensate-rich nest assets and helping enhance ARC's free cash flow profile. Together, we see the ability to improve our margins and create efficiencies through shared learnings across a much broader Montney asset portfolio that will benefit from economies of scale. This combination diversifies our production, geographic, and operational risk profiles, and we see increasing relevancy and liquidity for our shareholders. We believe that a dividend-paying company has a broader appeal to investors who have income or yield mandates. In the hundreds of investor meetings that I have participated in as a 7 Generations leader over the years, I have always been resolute in the fact that 7 Generations will not prioritize personal or management interests over those of our stakeholders or shareholders. This commitment to our stakeholders is what our company was founded upon, and it holds true to this day. This transaction is in the best interest of our stakeholders. I am proud of what we've accomplished at 7 Generations Energy in a relatively short amount of time, but also, and equally important, is how we have accomplished it, never compromising on our guiding principle and commitment to stakeholder service. At this time, both our management team and our board of directors feels that the right path forward for 7 Generations is to combine with an established, successful, principled company like ARC. I am looking forward to working with Hal to oversee the combined company's strategy as vice chair of the board and ensuring that together the combined company will thrive as a Canadian champion for responsible energy development. I will now pass the call over to Chris to walk through some of the transaction details and key financial aspects of the combination. Chris?
Thank you, Marty. As Terry mentioned earlier, ARC is excited to be beginning this new chapter of our company by combining with a well-regarded company like 7 Generations. I will quickly address the structure of the deal. ARC and 7 Generations have entered into a definitive agreement to combine in an all-share transaction valued at approximately $8.1 billion, inclusive of net debt. Under the terms of the agreement, 7 Generations shareholders will receive 1.108 common shares of ARC for each common share of 7 Generations held. The transaction has been unanimously approved by voting directors of both companies' boards and is subject to the approval of ARC and 7 Generations shareholders, regulatory approvals, and other customary closing conditions, which are expected to take place over the course of the next couple months. Canada Pension Plan Investment Board, which has been a 7 Generations shareholder since 2012 and controls 16.8% of the issued and outstanding shares, has entered into a support agreement whereby it will vote in favor of the transaction under the terms of the agreement. Closing is expected to take place early in the second quarter of 2021. As Terry and Marty have both said, we expect significant increase in free funds flow generation stemming from the combination. We expect to realize cost savings and synergies of approximately $110 million annually before tax, made up of corporate costs, operating efficiencies, marketing optimization opportunities, and drilling and completions efficiencies. The transaction financing is fully committed and consistent level cost, stable debt, and is expected to have an investment-grade credit rating. Ample liquidity will support a strong deleveraging profile through 2021 and 2022. At forecast commodity prices, we expect to reduce our net debt to 1.3 times funds from operations by year-end 2021. In connection with the combination, ARC has entered into a binding agreement with RBC Capital Markets and CIBC Capital Markets, who are acting as joint book runners to provide the company with an underwritten aggregate credit facility commitments of up to $3.5 billion, which will ensure an ability to optimize the capital structure, including retirement of 7 Generations outstanding senior notes, while maintaining adequate go-forward liquidity. With that, I'll hand it back to Terry to provide some closing remarks.
Thanks, Chris. So if we add up all the things we just discussed, you'll understand why Chris, Hal, Marty, David, and our respective boards support this strategic Montney combination. As individual companies, ARC and 7 Generations have both worked hard to become resilient, especially during these uncertain and volatile times like today. Together, we will form a strong and sustainable business with scale, a premium suite of world-class Montney assets, operating expertise, financial strength, and leading ESG performance, all key elements in our business that will truly differentiate us as a leader in responsible energy development.
And with that, I will turn it back to you, Colin, the operator, for questions, please.
Thank you. Ladies and gentlemen, we will now begin the question and answer session. Should you have a question, please press star followed by 1 on your touch-tone phone. You'll hear a 3-tone prompt acknowledging your request, and your questions will be polled in the order they are received. Should you wish to decline from the polling process, please press star followed by 2. If you're using a speakerphone, please lift the handset before pressing any keys. Your first question comes from Michael Harvey from RBC Capital Markets. Michael, please go ahead.
Yeah, sure. Good evening, guys. Congratulations on the deal. So I guess a couple questions. I guess first on the synergies, you flagged that 110 annually. The corporate costs of 45, I think, are pretty straightforward, but maybe you could just fill in some of the specifics around the balance of that, just because it is a big part of the free cash flow contribution. So just any additional details you can provide in that regard. And then the second part is just kind of on your capital allocation strategy and the portfolio ranking over the next couple of years. Obviously, the 21 outlook looks to be pretty much a summation of the two companies, but just wondering if you can let us in on your thinking of how that split will change in the coming years, i.e. which assets would you consider to be the ones to take more capital and which ones less, and just how the Attachie play and its significant price tag kind of fits into all this. That's it for me.
Okay, well, thanks, Michael. It's Terry Anderson here. Appreciate the questions. So regarding the synergies, and by all means, Chris, jump in on any more details here. On the synergies, we see lots of opportunities on the operating expense side and in the capital costs. So we'll be able to gain more purchasing power through a whole bunch of different avenues, like for chemicals, maintenance, fleet vehicles. We think there's consolidation in some of the gas plants. So there's probably at least 3% reduction in all of our operating expenses that we see that will add up to around $15 million annually on that. Same on the capital side. So obviously we will be able to, I guess, command better pricing from the perspective of having more drilling rigs together, more frac crews, and just the design and execution of the plan. I think there's savings there from being able to consistently have rigs, the same rigs, hopefully going throughout the year. That's how ARC runs the business right now, having 2 rigs that go steady throughout the whole year, and we don't ramp up or ramp down. If we can actually keep them steady through that time, there's some savings through that. So that's kind of some of the more of the operational side, but also on the transportation, midstream, 7 Generations has some unutilized transportation on Alliance, which actually ARC could utilize. So that'll actually help out on that side too. So that's kind of a few of the details on the synergies. When you talk about capital allocation, first step for us is reducing the debt. We need to bring that back into our comfort range. Obviously, when the deal closes, it'll be above our top end of our range, and but based on the forward curve, we'll be bringing that back within the year. So that's pretty quick, and that makes us comfortable on that. Then from there, then we can actually look at, you were talking about portfolio ranking. Well, we have way more optionality now, true optionality of focusing more on liquids or focusing on gas. And so depending on what the prevailing commodity prices are, we can look at doing that. The nice thing, Seven Generations has some unused capacity on facilities, so we don't have to spend capital. We can have half cycle economics to drive more of the liquids production. But eventually we want to advance Attachie, sanction Attachie down the road here. But first thing, we need to get our debt down to that low end of 1.0 times before we start thinking about Attachie now that we've taken on this combination. So I think, I don't know, Chris, if there's anything else on the capital allocation front. I think the nice thing about this opportunity is there's significant free cash flow, and after that debt gets down to where we want it to be, I think we can actually pursue a number of different investing in our actual assets, but then also there's opportunity for share buybacks or dividend increases, but that's not within this year, that's for sure.
And Michael, I think I would just reiterate what Terry was talking about. So clearly a short-term focus just to bring that debt down a little out of the gate, back into our 1 to 1.5 times range, and then tying the, our dividend increases going forward to the increase in corporate profitability, which can come from increased pricing or from incremental growth on, as Terry mentioned, either the Attachie asset or expanding the Nest asset. Both of them are great opportunities. And really it is going to be a focus on shareholder returns going forward, both to, similar to how both organizations have been driving here in the past as well.
Gotcha. That's helpful. Thanks, guys, and congrats again.
Thank you.
Your next question comes from Arun Jayaram from JP Morgan. Please go ahead.
Yeah, good evening. I had a quick question on slide 8, where you go through the pro forma in 21 and 22, the free cash flow yields. I was wondering if you could, it looks like on a combined basis, low double digits in 21 and in the mid double digits above that in 22. So could you talk a little bit about, some of the priorities as you get out to 2022 in terms of returning cash to shareholders, and to get to that 1.3 times target, how much gross debt reduction do you anticipate over the balance of the year?
Well, I think I'll turn it over to Chris to get into some of the details, but out in 2022, we'll be in a position, I think, to be able to look at possibly sanctioning of Attachie out there. So looking at potentially investing into our business. But maybe, Chris, you can get more into some of the details.
Yeah, I think that's fair. So, I think, as we mentioned, the key for us in the near term is going to be taking that free cash flow and really putting it towards the balance sheet. Obviously, the price deck that you see on slide 8 is it's 50 and 250 gas. So it's a pretty reasonable deck, we think, relative to where today's price environment is. Obviously, strip is above that, and that's obviously supportive of this. In terms of net debt reduction, we would see anywhere from, I'd say, $600 to $800 million net debt reduction from end of 21 to the end of 22, if we're in a sustaining mode. We have mentioned that if prices are supportive, we want to make sure that we are allocating capital across the portfolio to all of our opportunities, driving down net debt and focusing on shareholder returns. And again, I did mention, the increase in dividends, which really is the primary focus of our shareholder returns in the near term, tied to growth in the underlying assets and profitability there, or a permanent increase in pricing going forward. So I think that's how we would look at it. Obviously, the right side of that slide has some sensitivities that kind of gives you a concept of how much torque there is to the upside from this combined entity to either natural gas or WTI, which via condensate.
Great. Just my follow-up, as part of this transaction, you talked about the the pro forma inventory depth here, how far down the line do you think the combined entity will have to think about portfolio renewal, or does this kind of push that to the back of the line in terms of thinking about, adding incremental, inventory?
Yeah, fortunately, there's a lot of inventory. We have decades of development opportunity on both sides of the fence on both companies. So we're in a very fortunate position. ARC itself has decades of opportunity before the combination. 7Gens had decades of opportunity. Now we're just a much bigger company with so much development opportunity that we don't need more acreage. We just are going to be able to develop internally going forward here and grow our production base in the future. So inventory is not our concern, that's for sure.
I think another
Great,
way.
thanks. Oh, go ahead.
I was just going to say, another way of answering that question, it's going to lead to the M&A portion of that question. And I think, both 7 Generations and ARC had extremely similar M&A criteria. So we are not M&A shops by any stretch. So I think we're comfortable in saying that we certainly don't need M&A going forward. But again, if something else presented itself, we would evaluate it. But given that we've got the exact same criteria, that's why this transaction makes sense to both organizations.
Great, thanks a lot.
Ladies and gentlemen, as a reminder, should you have a question, please press star followed by 1. Okay, your next question comes from Patrick O'Rourke from ATB Capital. Patrick, please go ahead.
Oh, hey guys. Congratulations on the transaction here. Just kind of curious, and to go back to that capital allocation question, and Attachie keeps coming up here, and just wondering, when you think about the scaling of a project like Attachie, and take a look at that, relative to, say, some of the excess capacity that the 7-gen gas plants have right now, and the allocation of capital towards growth. I know you guys, both companies have been very thoughtful allocators of capital. How would you think about the filling up of those gas plants and the rate of return and the present value of that versus, say, the initial investment in Attachie?
Thanks, Patrick, for the question. So I guess that's the luxury that we will have of having that spare capacity on 7 Generations assets, that it's half cycle. So if oil prices stay robust and condensate differentials are supportive, then that's probably the place that we would first invest to get that half cycle economics on it. And that's something that I guess we have the capabilities to grow that production. The inventory is there. We can grow it if we want. But first steps first, we need to keep production more or less flat on both sides of the fence here, because we need to integrate these assets, get everything running smooth, drive down that debt, and then we have that optionality of deciding where to invest in our business. And it's nice to have that optionality. Attachie is a big block of land that someday we want to obviously progress and get the value out of that. But really, it's whatever is going to be the most profitable for us and make us the most money that we're going to allocate the capital to.
Okay, and then you talked about some of the synergies there and the corporate synergies. One of the things you touched on in the press release there is the investment grade, or hopefully the investment grade credit rating. And just wondering, how important that sort of aspect was to this deal, and what that could, potentially mean to the margins in the combined business going forward.
Yeah, I'll take a stab at this, Patrick. I mean, I think it was one of the benefits of the deal. It was never really, one of the primary reasons. I think you've got two organizations that think very similar and two high quality asset bases, and we thought just bringing them together certainly gives you the scale and the financial strength to make that investment grade. But it was more of an outcome than it was a design criteria, I think. If you think of obviously, the cost of the combined debt levels right now, it will be a very material number, and that, it's not explicitly built into our synergies at this point in time. As you know us, we want to get something contracted before we would actually talk about it. So, we'll be able to report out on that as it comes along, but it could be a fairly material number.
Okay, thank you.
Ladies and gentlemen, as another reminder, should you have a question, please press star followed by 1. Okay, so there are no further questions at this time. Please proceed.
Thanks, Colin. And I guess that's the beauty of releasing a transaction late enough in the day that we probably lost a lot of people out east. So I did want to thank everyone for joining us tonight. And just to be clear, both the Seven Generations and the ARC team are available for general investor relations call after this. So I thank you for joining us tonight, and I look forward to chatting with everyone.